And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Bartels of Bank of America and Dave Nadig of ETF.com. Let's kick it off today with retail getting swept up in the escalating trade tensions again. The popular XRT retail ETF down 7% just this month. 4-month lows today. Higher tariffs are squeezing these big retailers. This coupled with Amazon's dominance and the consumer shift from bricks to clicks has put many big retailers in the gutter. What's the best way to play this space? Dave, we have talked about this many times, but it's pretty simple right now. You had Amazon, and now with the additional tariff costs for these companies importing goods from China, they're all getting squeezed.
Yeah, and I think there are a couple of ways to play this if you were trying to catch a bottom here, which, let's be honest, could be tricky. XRT, which is the big famous one in this space, equal weights over 90 holdings, so you're not actually getting very much Amazon or anything else there. Something like RTH, which is the Van Eck equivalent here, market cap weights, the flip side of that is you're getting like 25% to Amazon. Top 4 or 5 holdings are almost 50% of that portfolio.
The problem with this whole game here is that there are times when Amazon is outperforming, therefore that market cap weighted one will do better, and other times when there's a little more pressure on retail or Amazon's not doing as well, where you get the opposite effect. So it's difficult to, it's almost like you have to switch in and out to really generate alpha, but no one knows when that's going to happen.
It's definitely one of those themes where you have to have a position. You have to believe certain retailers are going to rebound for certain reasons, whether that's bricks and mortar, large firms like Walmart claiming that they have strength coming out of a trade war, or whether it's just going for a pure retail online play.
Miriam, what do you tell your clients when they ask about retail?
So generally we like the space, but obviously Amazon has really disrupted. We really talk about digital disruption. But then we want to look at the fundamentals and look at consumption and consumer spending. And we just came out with a report today saying that the low-end consumer actually is spending. So the low-end consumers that or retailers that we generally think about, we think will do well because you have consumption across the board. So this has been a dislocated market for several years. It's probably going to stay a little bit more dislocated, but it doesn't mean that you don't want to be in the space. So we want to take a more diversified approach. We'd rather have broad consumer discretionary exposure and diversify across, not just having retail. And our favorite ETF there would be the iShares, and the ticker symbol is IYC.
That's the consumer discretionary.
They call it consumer services.
Right.
We'd rather have broad than just be very specific.
And that brings in a bunch of retailers in addition to manufacturers of consumer goods.
Exactly.
Yeah.
But yet, Dave, one of my favorite ones in this space is Click, C-L-I-X here. And they have a rather unique, this is ProShares, very interesting company. They have a rather unique approach to doing this. They're going to go long a basket of online retailers that are 100% revenues online, and they want to short bricks and mortar stores. It's a very unusual way to sort of play it. 100% long, the book's 100% long on retailers, online retailers, and they've got a 50% short on old brick and mortar stores. I think it's a very creative idea. We keep talking about this all the time.
It's classic pairs trading. We learned about this stuff in business school, right? You like Coke versus Pepsi, you go long Coke, you short Pepsi. That's really what this strategy is doing. It's just doing it in the whole space. I think it's a very interesting way to put your money where your mouth is. It gives you a little bit of insurance if the whole retail sector continues to be flat.
The problem I have is that you get this concentrated weighting in the ones that you're long. So you're looking at a quarter of the thing is Amazon here, and 14% you see Alibaba, Shutterfly, Groupon. So you got almost 40% are 2 stocks. That are in this. That's a pretty concentrated
there's no question this is an aggressive play on the space, but having that short component does give you some hope that you can still perform in the strategy even if retailers stay flat or decline a little bit.
Bob, what we really stress, and what's really shocking to most of our clients, is less than 10% of retail sales is actually done online. We see tremendous amount of growth opportunities still online, so I can understand why ProShares would develop a product like this.
Are you recommending? But you still have that broader viewpoint with the IYC. You're not diving into this trade.
We do not follow. We don't follow that ETF. We don't have an opinion. But I think what's important for investors to understand is that the digital period is dramatically changing the retail space. It's changing a lot of spaces, but it's dramatically impacting what's happening in retail.
Okay, let's move on here. I want to talk about something that we've gotten a lot of email about. People want to know about Bitcoin because it's back in the news again. So let's move on to one of our more controversial conversations on Wall Street. Bitcoin, of course. The cryptocurrency doubling in price this year, now trading around $8,000. This is the clock ticks for approval on another Bitcoin ETF. The SEC scheduled to make a decision on the Van Eck Bitcoin ETF by tomorrow. Last week, the SEC delayed a decision on the Bitwise Asset Management Bitcoin ETF. Similar, but not quite the same. Are we any closer to this become a reality than we were before? Were we here a year ago doing this?
I think we're still going to be here in a few months.
And the SEC, a year ago, I think it was January, issued their concerns. Their concerns, two principal ones. One is about custody and showing to us that the custody is safe. And the second is the fact that much of the trading takes place outside the United States on exchanges that could be easily manipulated. Has anybody come close to addressing the SEC's concerns?
Well, certainly everybody who's filed an ETF has put hundreds of pages of documents back to the SEC trying to close some of these gaps. But based on the comments we saw last week around one of these filings, it's clear the SEC is still in information gathering mode, not like let's sit at a table and make a decision.
They keep putting them off. You know, there's these 40 to 5-day periods that they get, and they keep really rolling it off.
Technically, there are deadlines, but honestly, it's the SEC. They can do what they want. They can kick this can down the road until they're comfortable. It's clear from what we're hearing.
Well, the way they kick it down the road is they can just ask them to withdraw the application, right? That's how they kind of get the
Or they can just reopen for comments again, right? I mean, they really can delay this.
So I think it's your opinion this is going to same thing's going to happen tomorrow.
I totally think so, and I think that we are still in that information gathering mode. I think things are pointing towards a positive resolution for Bitcoin bulls, but I don't think it's imminent. I still think we're at least a quarter out.
You think something will happen eventually?
I do, and I think there's still a reasonable chance for this year.
This year. And how do you address the custody? I mean, just going back to these two issues, they want to know that the things are safe,
right?
Okay, and when there are stock custodians out there, nobody's afraid. We know who to go to sue if XYZ custodial firm loses the stock.
Right.
Can they answer this question?
I think those questions, the way the Bitcoin is put into cold storage and the firms that are doing that, I think those questions have largely been addressed. Most of the headlines, the scary headlines, if you're a Bitcoin bull, have really been around exchanges, not around custody. That gets to sort of where these things are going to be traded and how prices are derived. Those concerns, I think, are also being well addressed.
Well, Fidelity Investment, for example, I know they wanted. They're trying for a custody and trade execution offering down here at the New York Stock Exchange. We have BAC that's been worked on for a while now. They want to launch a futures contract that's out there. So there's what I see happening is definitely institutional movement quietly in the middle of the Bitcoin winter or the crypto winter, whatever you want to call it. There has been work being done,
and that's what we need to see. We need to see this market mature, and as it matures, the regulators will get more comfortable.
Okay, let's move on. Talk about one of my favorite subjects, space. We're going to end with a strategy that's out of this world, literally. The UFO Space ETF is launching. Last month, comprised of 30 companies, derive a majority of their revenues from space-based operations. The man behind the ETF, Andrew Chanin, Pure Funds, joins us now. Andrew, tell us what's behind this. How does it work, and how's it been trading for you?
So the Procure Space ETF is a fund that I've been very interested in bringing out, and it's one that not only kind of captures what people's imagination is, but it actually is investing in this very real industry that we've seen emerge quite dramatically over the last several decades. And right now, we're looking at an industry that's comprised of satellite companies, launch equipment manufacturers, and it's something that both is very important on the commercial side as well as on the government and national interest side.
I asked you for some stats because the space economy is growing and it's becoming more important here. Annual global spend, $384 billion. That's a lot more than I thought it was going to be. Commercial is 80% of that spend. Governmental is only 20%. That's remarkable to me, and this is, I think, obviously because of the efforts over at Amazon, of course, SpaceX as well. Who would have thought this would have been 80% commercial 6 or 7 years ago?
So if you look at what is really driving the space industry right now, we're talking about some of these transformational technologies, things like 5G, cloud computing, Internet of Things and connected devices. If you believe in those industries, you're saying there's going to be a massive increase of data. And these satellite companies are actually actually the backbone and the toll operators for this road that transfers data.
That is an absolutely critical point to make. So now you're making a connection between the Internet of Things, 5G, cloud computing, and you're saying there's a connection between this and space because the way we get all this data out into the world is we're going to send it up into space and use satellites.
Satellites
That's the connection.
Are absolutely critical for this, and most people are overlooking that aspect of it.
How important are things like NASA contracts to these firms, or is this pretty much just independent of whatever the government really decides to do? I mean, I was surprised to see that 20% big G number too.
And so that 20% that Bob mentioned, that includes NASA and other agencies. So this 80% drive, a huge push comes from broadband and internet communications. There's also some industrial exposure, but if you look at the way that the space index that the fund tracks was actually built, it's 80% of these companies that are deriving a majority of their revenues from space-related systems and services.
So you have a pretty high bar here, because I noticed they're mostly satellite companies that you're looking at here. You know, we're looking at Inmarsat, Globalstar, Maxar Technology, Intelsat. These are satellite companies.
And companies that not a lot of people actually hold in their already existing exposure. So another thing that was important was not just did we want to bring out the Procure Space ETF to be the first pure play space ETF, but we also wanted to really capture what the broader space industry looks like. And most people don't have that exposure currently, so we provided something really new for investors.
Marianne, is this all a little too spaced out and too general,
well, it reminds
too specific
me of
rather for you?
Infinity and beyond. But with that, we actually do have a forecast for space, and we've estimated that the market by 2045 can actually be close to $3 trillion. So based on the numbers that you've talked about, we see tremendous amount of growth
that's
in this
like
area.
8 times what we're talking. Because 384 is what we put up here. That's 3 trillion would be 8 times.
Our exact number is 2.7 trillion by 2045.
Nice.
And you think, what is going to drive that growth? Obviously, it's going to be more than satellites going on here.
Well, it's digital. And I think this is what the world is underestimating, is that the power of digital, the power of 5G, and the growth in all the markets, whether it's cloud computing, whether it's semiconductors. I mean, we have short-term hiccups here in the marketplace, but the long-term prospects for the growth in digital is quite large.
Now, Andrew, I see satellites on here. The obvious things I don't see, for example, I have a question mark here. Boeing, Airbus, Lockheed, are they in the fund? Aren't they sort of related to space somehow?
They are. However, they're considered diversified companies. So if you look at the fund, it was very important that 80% at least of the weight was focused on these pure play companies driving more than 50% of their revenues. If you look at some of those more industrial defense names, aerospace names that people are familiar with, because it's not a pure play, they fit into this 20% diversified tranche. So you are getting exposure to these companies that are huge players, but because you don't necessarily want a fund that's going to be guided by these companies that aren't necessarily deriving their revenues from this theme, that's why they have this.
And you started
tranche.
trading when? Just a few months ago, right?
This fund just launched in April.
Yeah, so there's not a lot of time to see the track record, but we know your argument is very compelling. I mean, if you could connect the magic words, Internet of Things, along with the other issues that are there, of course, what we were talking about, the other tech issues with satellites, you're going to get the tech people buying in, the radical tech people.
We certainly hope so, and there's some other mega trends that are actually occurring. So some of these things like reusable rockets are lowering the cost for individuals to actually launch items into space. They're looking at smaller satellites, so you can actually put more satellites into space at a lesser cost. The sensors on them are even more powerful than they ever were before. So there's a lot of driving, not just from the commercial side, but also from the government side, and some of these broader projects, like us building a permanent base on the moon possibly in the future.
Internet of Things, 5G, cloud computing, connected with satellites.
Got it all.
I love it. We're wrapping all the high-tech stuff. All us geeks love that kind of stuff. Thanks very much for joining us. I really enjoyed listening to it. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave and Marianne and Andrew for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We're off next Monday for the holiday, but we'll see you next Wednesday for a special show. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.